Keith is known as a bit of a macro megamind. He's especially so in the gold and silver space. He is the founder and CEO of Monetary Metals, as well as the Gold Standard Institute, which promotes the use of gold as money. And he's the author of many respected opinions. He's a contributor to many reputable outlets such as Forbes, Kitco, Seeking Alpha, and even the Mises Institute, where he has been a keynote speaker. And he may be the only person with as much negative stuff to say towards Bitcoin as Peter Schiff himself. So with that being said, Keith, if you go ahead and... Oh, there he is right there. Keith, welcome aboard. It's good to have you.
Hey, good to be here. Thank you.
Yeah, our pleasure. Look, I'm really familiar with your work, and so it's for that reason I know you're the perfect guy to have on right now and to really provide some color on what's going on and discuss the potential solutions to a lot of these problems that we have. But let's break the ice by kind of getting into some of the recent economic headlines, especially with these job numbers that were just posted. I mean, Keith, I feel like we live in the upside down. Every time official data comes out, it's hard to believe it. I mean, even with the CPI, you got to go to shadow stats to get the real figures. They don't want you to know how bad inflation is. 2 consecutive quarters of negative GDP has always been the case for a recession, and now we're actually debating these definitions. Even in the case of unemployment, you have U3, you have U6, and there's always a preferred number to report. And, as we get these job numbers, it just feels a little fishy to me. I mean, you have a Six Sigma blowout, unexpected numbers at the same time they're reporting a decline in participation. When you see figures like this, how do you read that? How did you see that jobs report? And how do you see the state of things as a whole right now?
Regardless of whether or not this is officially a recession, which, if you go by the NBER, you kind of have to wait for them to let everything settle and all the revisions to the data are finalized before they'll actually tell you that or not. Clearly things aren't good. And I think that's the main thing. The second main thing is that all of these statistics, I don't necessarily agree that when they calculate CPI, they're lying. But all of these statistics exist to help the central planners centrally plan. So that is, all of these statistics are political in nature. The definition of recession, the definition of GDP. I've written at length why GDP is a worse than useless, at best misleading, measure of the economy. And we can talk a lot more about that if you want to go in that direction. We have all this data coming out, and each political party is trying to spin it, to their advantage. The Republicans have a point; things aren't good right now, but of course, it's completely wrong to say, well, it's just Joe Biden. I mean, the deficit, the Federal Reserve, monetary policy, these things are bipartisan, and the effects of those policies, have lags that can sometimes be years or even decades. And so we're in a mess. And the other thing that needs to be said, I suppose, is that unemployment or employment is a lagging indicator, because, companies have a decision cycle, they have a decision loop. They say, okay, based on whatever, period, we're going to hire. And then it takes a while for that to work through, where all of a sudden, things are bad enough that they say, well, we're going to not only stop hiring, but we're going to actually do layoffs. That's a lagging indicator. And so that wouldn't necessarily tell you where the leading edge of the quote unquote recession is anyways.
Right. So what's your sense of the economy then? Do you believe a lot of the numbers? Do you agree with the Fed that we have a relatively strong economy now, backed by a strong labor market, or do you think that we have signs of crack showing here? And beyond that, I mean, if this data is political in nature, do you foresee a time when this starts to backfire on them for not shooting it straight from the hip, or is it going to continue to provide them cover to build the narratives that they want to build?
Oh, I think they're good at creating cover. I wouldn't short that. The government's ability to issue statistics and economic pseudo arguments to give themselves cover. I think we got many good years left for that particular one. I'm saying that slightly tongue in cheek. As far as good economy or strong or healthy economy, absolutely not. Like everything in our politicized world today, we flip-flop back and forth between two different false alternatives. On the one hand, or I should say at periods, the Treasury and the Fed are stimulating us. And what does that mean? That means that they are incentivizing us to consume our capital. I mean, the government can't make us actually richer. However, they can make us spend more. And if we're not producing more, we're not actually getting richer. How do we spend more? Well, we're spending our capital. And so there's times when they're stimulating us to spend our capital. They make us feel richer. This is called the wealth effect. And I've written many times that the wealth effect is not wealth in the way that spray foam cheese substance that comes out of a spray can is not cheese. It's just something that's colored to sort of vaguely look like it. And then at other times, they, for whatever reason, hit the panic button. And then they say, oh my God, we better stop stimulating. And then the effects of the after effects of all that stimulus, i.e. the debt, right? So we're borrowing to consume. And then when the binge is over, when the bender is over, then there's the debt service. And then they stop stimulating, and then things become harder to pay. And then that's the flip side, which, if it gets severe enough, or if the Fed doesn't react and go back to stimulus mode fast enough, then we call that recession. The elephant in the room here is that we're in a long-term falling trend for interest rates, right? I mean, the interest rates have been falling since 1981, and the Fed, as in 2015, as in 2005, thinks that it can, hike interest rates. So what happens is they hike what's called the Fed funds rate, but the longer term interest rate, is a lot less subject to the Fed's control. And so you get an inversion with the interest rate on, let's say the 1-year Treasury bond is higher than the interest rate on the 10-year Treasury bond. And since the banks are in the business of borrowing short to lend long, the liabilities are going up in cost of service, while the interest rate they get on the longer assets that they buy are not going up or even going down. And so you put stress on the banks. And so if the banks are under stress, they obviously can't lend as much. Credit pulls back everywhere. Suddenly dollars are harder to come by. For the debtors, that's particularly acute. And then everyone says, okay, we flipped into recession. How is the Fed? Let's go back to our masters, the ones that alternatively stimulate us with cocaine and beat us with canes. Let's go back to our monetary masters and now beg for them to go back to the cocaine, false alternative. And, the question is how long will the pain continue to mount before we go back to begging for more cocaine?
Right, exactly. And you had mentioned, do they stop stimulating? Well, what about the banks lending? Because how would you assess this $2.2 trillion reverse repo? What does that mean? Why is it significant? And is it something to pay attention to? Where's this money going to go?
So I'm trying to think how to organize my thoughts, because we kind of have a two-tiered credit. It isn't money, it's credit. I think it's really important for people to keep in mind money is a final settlement of a debt. It is a commodity that you can physically hold in your hand and take home. When you want to leave the sandbox, you can take your marbles and go home. And that's gold, of course. So in 1933, FDR takes what I have to grudgingly concede is a brilliant, evil, brilliance in the service of evil, but I grant that it's a brilliant move to take away the right of people to remove their marbles and go home. And so, before 1933, if you didn't like either the interest rate on offer, the risk of the banking system, or anything else, you could just take your gold and go home and say, I'm not going to fund the banking system. I'm not going to fund the credit system. After 1933, the most conservative savers are now forced to turn to Treasury bonds. So there's no longer, it's a closed loop. There's no longer really any escape. You can personally escape now. After 1975, they re-legalized gold, but you're buying the gold off of somebody else. He's just simply taking your place. He holds the dollars that you once held, and he's trapped. He finds himself in the same trap that you had been. So from an economic standpoint, buying gold from somebody else has no effect on the system was before 1933, withdrawing gold from the banking system had a very profound effect, which is why they, eliminated that in 1933. So, today, we have this cockamamie system, and I use that word because the more you study it, you just have to, I'm not sure whether it's awe or just shaking your head and just giggling at the silliness of it all. We have this bizarre system where what they call base money is credits issued by the Federal Reserve. And those credits can only be traded between the Fed, the Treasury, and the privileged crony banks that get accounts at the Federal Reserve. That's it. So that so-called money is trapped. It's a credit relationship the Fed maintains on its books, and there's a very limited set of parties that are eligible for access to it. However, when a bank has a credit there, which is the asset to the bank and liability of the Fed, and the Fed issues that liability in order to purchase the Treasury bond, which is the Fed's asset. So the Treasury has a liability, which is the bond, that is the asset of the Fed. Keep that in mind at all times. And then because the Fed has the asset, then they issue their liability, which is Federal Reserve credits, if you want to think of it that way, to the banks, which are the bank's assets. When the bank has that asset, then the bank is, in theory, free to issue its liability and expand credit in the economy. But there's this weird indirection where what the bank holds for Fed, the Fed credits are not really fungible. The bank can't pay those out to anybody. It can only pay that to other banks in settlement, or to or from the Federal Reserve. So now getting to this reverse repo, the banks held quite a lot of Treasury bonds, and with the advent of what they called quantitative easing. And getting back to my comment earlier about, no, they're really good at coming up with cover for their actions. So they invented this term quantitative easing around 2008 or early 2009 to put I think it was intended to be a friendly label, although as with all of these things, like when the schools have a class for the problem kids and they call that the special class, then very quickly the word that was intended to be euphemism suddenly becomes a bad word. And then I think the next time they do this, they're going to have to call it something else. They can't call it quantitative easing anymore. Anyway, so they coined this term quantitative easing, and the Fed buys bonds off the banks. That's what quantitative easing is. The Fed does not buy the bonds directly from the Treasury. The Treasury sells new bonds, the banks buy them, but the banks know that the Fed is going to buy the bonds off the banks. They turn it around, unload it to the Fed at an uptick in price, which means a downtick in interest rates. That's part of how our system is wired today. And then the Fed has the bonds, and the banks get back their Fed credits looking for the next asset to buy. And so when the Fed loads up a disproportionate amount of bonds, then the banks are sitting there with Fed credits, or AKA reserves. And then this put the banks under stress on the income statement. So then the Fed said, okay, well, we'll pay you interest on your so-called excess reserves. So then the Fed is paying the banks interest to hold these credits, which are doing nothing productive. Anyways, it puts the banks in a bizarre situation where their balance sheets are bloated above the need for any real assets. So the Fed says, okay, well, we'll reverse repo Treasury bonds to you, which is basically we'll give you the Treasury bond and a promise to buy it back, and then so you can earn the interest on it in the meantime. So it's just really, repo with the Fed and reverse repo with the Fed really are just signs as to that balance between how much Fed credits the banks have and versus their payload of how much Treasury bonds they have, and whether the Fed got the balance right. And if it didn't, it's going to either do repo or reverse repo. So in that sense, I say, yeah, it's significant because it's talking about sort of a policy error, but it's not significant in the way I think most people want to look at it, which is any kind of harbinger of hyperinflation or dollar collapse or what have you.
Okay, that makes sense. So you talked a lot about the debt-based system right there. So all of that considered, how in the world do you possibly transition out of a debt-based system, especially because in many ways this debt has made it possible to have a lot of the progress we've had, right? And you could make the argument of, well, how could we have possibly made it this far without the debt, right? What do you say to that, especially as it's psychologically part of our normalcy bias? This is the way life is. We expect to grow at this trajectory that we've become so accustomed. So how do you transition away from that?
You know, so many political arguments, and the same thing with taxes and government programs, essentially become an argument in favor of what I think should be called a package deal. So, you take a look at debt, and debt has two flavors. There's the debt that is put in place to finance an increase in production. So, let's say I have a factory and I need to borrow $10 million to put in another assembly line, and I'm going to increase my production of widgets, or I'm going to produce some new kind of widget that's never existed before. Well, that's good, because the lenders are going to be repaid out of part of the profits from the sale of the additional widgets. So the investors get a return. I get a return because I'm making an increased profit by producing more. And society gets a benefit because there's a new widget available that does something that presumably, if I did my job right, that there's actually demand. People actually want it. Makes their lives better in some way. So that's good. And there's no particular limit to that kind of debt. Companies are increasing their profits and increasing the benefit to society by financing it that way. But there's another kind of debt that really should be thought of as a counterfeit debt, because the borrower lacks the means and intent to ever repay it. And of course, as soon as you say it that way, the very first borrower that comes to mind, when you frame it in those terms, is the government itself. The government is not borrowing in order to create a productive asset. The government is borrowing in order to spend it down, piss it down some sort of welfare drain. And so they're calling it borrowing, but it's kind of like, if you remember the old Popeye cartoon, what was it? Blimpy, what was the guy's name?
Wimpy.
Wimpy. I'll gladly pay you on Tuesday for a hamburger today. And the thing that sort of made it funny was he obviously had no means to pay for the hamburger today, or would have the means to repay you on Tuesday either. So it's not really borrowing, though they call it borrowing, and they go through all of the motions and give it all the pomp and circumstance, and the official seal of the U.S. Treasury Department, signed by the Treasury Secretary, and all this stuff. But it's not really borrowing; it's a counterfeit. It's a fraud that will never be repaid. And so what the Fed, and I'll use the word collusion, in collusion with the Treasury, over many, many decades, has racked up an enormous amount of debt that can never be repaid. And there's no means to repay it, and there's no intention either, right? Everyone only just talks about, well, we'll just borrow more. And then you're a real hawk if you talk about borrowing more at a slower rate. Oh my God, what an extremist! And it's not on the table. It was, even when Trump was running, it was never on the table to say, okay, we're going to actually spend less than we take in the tax revenues and try to pay this thing down. There was no intention to do that even 40 years ago, and certainly by today, there isn't a means anyway. I mean, there's no conceivable way you could amortize that debt, even on a 30-year schedule, with any kind of income. So $30 trillion, approximately 100 million people in the productive private sector workforce, $300,000 is the share of the debt to each working person. So two married couple, if they're both working, $600,000 debt burden just for Uncle Sam's debt. And then your state probably has more debt, the city you live in, the county, the municipal water district, all that debt on top of that. There's no way. It's just far beyond that. So what that means is what cannot be sustained will not be sustained. I mean, there's very few things that are certain in life, but that is one of them. If something's unsustainable, it is going to end. And if we don't change trajectories, and I'd love to talk about the change in trajectory, but if we don't change trajectories, the way that's going to end is by spectacular, catastrophic failure, and that will be horrific. That will be an event that will make 476 AD look mild by comparison, and that's where this thing is headed if we don't do something.
Okay, I want to get there, and I like where you're going with this. But right before we do, okay, all of this being understood, this foundation that you've laid out, everybody's arguing about the Fed and their policy and the pivot and their hawkishness and what they do next. If you're looking at the Fed, you're looking at the bond market, you're seeing the price action there, you're hearing the jawboning that they're doing. What do you see them doing next? What's their course of action here? I mean, mathematically, it stands to reason that they have a ceiling, a mathematical ceiling, because of the debt, like you talked about, and yet the market seems to believe they'll take rates to the moon. I mean, realistically, mathematically, what do you see playing out here?
Well, they've already inverted the yield curve, so they've already hit a ceiling of sorts. They've already created an unnatural beast that would never exist in a free market, which is interest rate for a shorter term is higher than the interest rate for a longer term. And that causes all sorts of stress to banks. The higher interest rate, so let me take a step back. One should think of asset prices, especially assets that are perpetual in nature, so real estate and stocks in particular, but also non-cash flow bearing assets, antique Ferraris and old masters paintings and all those sorts of things. One should think of asset prices as essentially the inverse of the interest rate. And, if there's interest, I can get into the technical, description of net present value and why it works that way. But every time you cut the interest rate in half, you should expect roughly a doubling, with leads and lags and volatility along the way. And, every day, Jim Cramer screaming about something or other on the Wall Street Journal, saying something similar, but in a more restrained, fashion. And the Investors Business Daily maybe going slightly deeper into all the reasons and the whys and the wherefores. But with every halving of the interest rate should be a doubling of asset prices. And this is wonderful fun on the way up, and it gives people the opportunity to load up on lots of leverage. And so if you think it's great to get a double in your portfolio, now imagine doing that with 90% leverage. It's even more fun. And then when the Fed decides, as it has now, to try to reverse and make interest rates go up, then that means the asset prices have to go down. And then to the degree that there's leverage in the system, falling asset prices is suddenly a calamity. And, one by one, leverage balance sheets fall over. So that's kind of the phase that we're in right now. How long can they take it? I have not done the analysis. I'm not sure the data exists, but if it does, I haven't studied it. To look at all the balance sheets that are out there and kind of get a sense of where's the big margin, at what interest rate, and therefore what asset price, to suddenly, $1 trillion wall of defaults, hit, and those defaults will blow holes in the bank's balance sheets. Suddenly somebody's defaulting, the bank has to take over the collateral, but in a falling market, the collateral isn't worth what it had been. The bank goes to sell it, which of course is a positive feedback loop. More selling begets asset prices falling farther, further collateral insufficiencies. Banks will fall over. The last time around we had Bear Stearns and then Lehman. This time, who knows? But I'm not sure what that number is. It hasn't happened yet, but clearly those stresses are mounting. And keeping in mind, of course, that it takes time, for defaults to go from, a late payment to 30 days late, 60 days late, 90 days late, formal notice, default, litigation, all those sorts of things. And meantime, the bank is in private negotiations with the borrowers to extend and payment in kind and all sorts of things, and the Fed is giving them emergency liquidity provisions to enable that. And so, you can extend if the Fed really wants to. This could be extended quite a long time, but inevitably, sooner or later, this all they have to resume the falling trend. The irony of all of this is the reason why they're hiking is they say that they're interested in combating inflation. so-called, which means rising consumer prices. And the irony of that is that consumer prices skyrocketed as a result of non-monetary forces. So for the longest time, we've had a relentless increase in the cost of regulatory compliance, which I call mandatory useless ingredients. And I thought of that term because I was thinking about how the regulators force the gasoline companies to put MBTE, methyl butatetraethylene, I may be wrong on that, something like that in every gallon of gas, which is useless. It doesn't do anything for your car, doesn't add any horsepower, doesn't make the fuel economy better. If anything, I think it makes it worse. I don't think, in most cases, maybe a lot of people are aware of MBTE because there's a sticker on the gas pump, but in most cases, the consumer does not value, and that's certainly the case of MBTE, the consumer does not value this ingredient that's mandatory, which is what makes it useless, and in most cases, the consumer isn't even aware of it. The consumer is just aware that, well, damn, the price of gasoline just went up 27 cents a gallon. Yeah, that's right, because you just forced the gasoline companies to put 25 cents a gallon worth of additional cost in there, and then to that 25 cents, they add 2 cents of profit. And so that's right. So the price went up. Everyone thinks that's monetary. Everyone is in the throes of Milton Friedman, who said inflation is everywhere and always a monetary phenomenon. And yet you have a very clear, relentless force for many, many, many decades of just ratcheting up useless ingredients, cost of compliance. That's number one. That's not particularly germane. There's no change in useless ingredients at the margin circa 2020 or 2021. But the next thing we had was lockdown, which destroyed production in so many different industries. And a lot of those didn't necessarily matter. I mean, whoever was manufacturing things for hotels, their production was maybe shattered, but then the demand for hotels was also shattered, so you didn't really see that. However, meat processing plants in particular were, hard hit by all the measures that, if one worker in a section of a plant had a family member that had a COVID positive test, that section of the plant would be closed down for 20 days or something. And so suddenly we had, on the one hand, farmers obliged to destroy huge numbers of animals because there's no longer a meat processing plant that could buy them. And on the other hand, the grocery shelves were empty, the freezer sections were empty of meat because the meat processing plants couldn't produce meat. So you had these effects of lockdown, which obviously caused spikes in prices. Then, we eventually unlocked, but that unleashed a whiplash in the logistics area in particular, where the ships were out of place. They were in all the wrong places. The rolling chassis, when they take a container off a ship, they put it on a chassis that has the wheels, and then they bolt that to the tractor, and away it goes. And so the logistics industry was, before COVID, running basically at full capacity. And in the United States in particular, because of union lobbied, regulations, it just wasn't a lot of flexibility to fix it. And so you had all sorts of shortages as a result of lockdown and then whiplash. Thirdly, you had trade war. And that wasn't just tariffs, and certainly not just tariffs on Chinese-made goods. There's big tariffs on added to lumber imported from Canada, tariffs on Scotch whiskey, all sorts of things being taxed. But not just tariffs, but also general political pressure to onshore things that were being produced offshore. And so Intel, for example, made news by saying they're investing $50 billion in building some new, very large semiconductor factories in the United States. There's a reason why that stuff was being manufactured in Asia. It was cheaper there. And if they're suddenly under political pressure to manufacture it here, which is their second best choice, then it was second best because it was more expensive. So, trade war, tariffs, but more broadly, trade war is also a force for higher prices. Next, we get to green energy restrictions, which the United States is less afflicted with than the UK or continental Europe. But let's look at the UK for a minute. The price of natural gas spiked, I think it was more than 10 times which is just absolutely, I want to talk about CPI, absolutely off the charts. What would Shadow Stats and John Williams make of something going up 10x? But what happened in the UK for energy costs? Well, they passed two stupid laws, and these are not at the time of COVID, but a couple of years prior. I want to say 2017. One of these two stupid laws basically bans domestic production of natural gas because natural gas is produced by fracking. They banned fracking. No more domestic production in the UK. And the other stupid law forced power companies and heavy industry to shut down their use of coal and oil and switch to natural gas, which no longer can be produced domestically, by the way. It has to be imported. So that obviously has a synergistic effect that the rise in the cost of natural gas due to either of those laws would be significantly less than the combination of both of them. Now enter the COVID, post-COVID lockdown reality where it suddenly becomes impossible to import plastic Christmas tree ornaments from China or anything else by ship. The entire shipping and logistics, supply chains are just a train wreck, no pun intended. And now you can't import the natural gas anymore that you thought you needed. And the price of natural gas absolutely skyrocketed, which leads to the next problem. Guess what is produced using natural gas? Fertilizer. So fertilizer plants all across the UK shut down because it was no longer profitable at that suddenly 10x or 15x the price of the natural gas, which means that food production is impacted and the price of food is going to skyrocket. Again, all of this being non-monetary. Finally, we get to Ukraine. And, regardless of what you think of Putin's invasion of Ukraine and the West's response to that, economically, it's pretty clear that the West depended quite heavily on Russia to export not only oil, but natural gas. So you have this desperate shortage of natural gas because the UK can't produce it domestically anymore. And then Putin is turning down the flow rate of the natural gas coming through the pipelines. So obviously, you just see skyrocketing prices there. None of this is monetary. So the irony of all this is that people think that Friedman was right, that this is due to monetary policy. People expect the central banks to hike the interest rate. Well, the interest rate is one of the key inputs into the cost of opening up a new plant to produce something. So if somebody was going to explore and develop natural gas in some jurisdiction that hadn't banned it, well, now we're hiking the interest rate, which means that their business case has to be postponed until prices go up even more. And so we just have an absolute monetary mess where people have got cause and effect absolutely backwards and understanding interest rates and prices. And the net result of which is that more economic pain is coming, and the people that are trying to centrally plan their way out of it, aside from the fallacy that you can't centrally plan the economy, in this case, the central planners have the opposite. Imagine if the car is veering to the left and somehow people thought that the solution to that is to pull the steering wheel to the left even more. That's kind of where we're at with the central banks and what people call inflation.
Right. And I nested some of your recent tweets here that refer to a lot of what you just spoke of. BASF cutting production of key fertilizer ingredients, to which your response was, look, the consequences will be inflation, right, of said product. And people will demand central banks to hike the cost of building replacement plants, at least in less green crazy jurisdictions. So, yeah, I understand that fully. I guess to follow up on that, a little bit more of the geopolitical economic circumstance. The one you didn't quite hit on as much as China. You got China talking about U.S. Treasuries being risk assets now. So I want to separate the reality from the noise. What's talk? What's blunder, right? And what's a red flag? I mean, they're under $1 trillion for the first time in 12 years. Is this any different than maybe a portfolio manager being overweight a particular asset and lowering their exposure a little bit, just balancing the books when you get a low overweight something? Or is this a big deal? Is this something we should pay attention to?
So I travel a lot around the world. And one thing that gives me some perspective on is I don't think anybody really likes the dollar. I mean, as a theory, as a hey, look at the monetary system. What do you think of the fact that the U.S. is the issuer of this currency that everybody needs? Nobody particularly likes that. The way this arrangement came about was toward the end of World War II, when it was clear the Allies were winning. The U.S. sat down with then the Allies, and of course later all the rest of the countries basically were forced to participate at Bretton Woods. And the U.S. dictated this is how it's going to be, because we have all the armies that are standing and all the productive plants. There hasn't really been domestic bombing in the U.S. In World War II, and the rest of the world was in ruins because of the war. So the U.S. said this is how it's going to be. Everyone assumes, and this was not good for the rest of the world, but they didn't have any choice. Everyone assumes, because there's an emotional appeal, there's a psychological temptation to believe in zero sum. If something is bad for them, it must be good for America. Well, this stupid plan, this evil plan, was the brainchild of Harry Dexter White at Bretton Woods. Harry Dexter White was later proved to be a tool working for the Soviet Union. And I think there's very little question that Bretton Woods was actually his attempt to undermine and bring about the collapse of America. So he came up with something that he thought would harm America and bring down the system that everyone else in the rest of the world assumes is good for America. And a lot of American politicians have been pretty smug about that. When the French said to, I'm trying to remember, it was Treasury Secretary Connolly, I think, about the problem with the dollar, and Connolly was very smug and said, well, it's our dollar, but it's your problem. Anyways, in the rest of the world, they don't particularly like the dollar, and a lot of places they hate it. However, leaving aside whether you love it or hate it, the international monetary system is wired the way it's wired. It works the way it works. And the bottom line is the dollar is on one or both sides of every major balance sheet in the world. The idea of that, the rest of the world is going to somehow rise up against this is just preposterous. And we might as well talk about, what if everybody in the world were to fly to New York City and all stand on Fifth Avenue, 1, 2, 3, jump? Could they knock the planet out of the orbit? I mean, there's just no mathematical way that could happen.
Right.
It's well, okay, that's number one situation. Number two, all the paper currencies in the world are dollar derivatives. So the idea that the derivative could ever survive the collapse of the thing that it derives from. So imagine someone saying that, I think that Apple shares are going to go to zero. However, September Apple calls will replace the Apple shares. It would just be kind of bizarre. You'd be like, do you understand what an Apple call is? Like, we're at that level of kind of, not understanding reality at a very mechanical level. So that's the second thing. The third thing is that for everybody who doesn't like the dollar, they wouldn't like any of the other currencies even more. So show me a world in which President Xi of China is eager to become a creditor to Putin, or for that matter, Putin eager to become a creditor to China. Each one of these countries has their own credit problems, their own credit abuses. China is significantly less transparent than the United States, and that's an understatement. Leaving aside, it's slightly problematic, and I'm being tongue-in-cheek when I say that. Capital controls, right? It's illegal to take capital offshore from China, and the Chinese citizens who have any degree of wealth are constantly risking their lives to evade those capital controls and dump the yuan to buy dollars. So leaving aside the capital controls, leaving aside the fact that China is significantly less transparent than the United States, they've abused their credit worse than the U.S. has. And I don't think anybody in the rest of the world is particularly keen to want to hold big balances of yuan, anyways, and certainly not Putin's ruble, certainly not Modi's rupee, Brazilian real. I mean, come on. So
right.
It's not noise in the sense that, yes, it's real that people are ticked at the dollar, ticked at what they regard as America's exorbitant privilege. That's real. They would love a way out of it. But, it's a very well-designed game. And I use the word game in the sense that economists, it's a system in which everybody has a role and there are certain rules. And there really isn't any paper currency that could remotely come close to replacing the dollar. And there isn't any path to get to that point. It is what it is. So if any particular country is selling off their dollars, then that's a sign of their desperate need for liquidity. And that's, in a certain sense, literally debasing their currency, the base of their currency being dollars. And if they're sucking the dollars out, if that were really true, and if this isn't some accounting gimmick or sleight of hand where they hold the dollars, but they shift it to the balance sheet of some other entity that's Hong Kong based or who knows what. If it really is true, then they're debasing their currency, and that would not be bullish for the yuan, that's for sure.
Right. Obviously, as you laid out very well, Bretton Woods gives the dollar a lot of advantages. And a lot of what you touched on was Brent Johnson's milkshake theory, right? And there's a really sound argument there, and it is almost self-evident here. But I'm going to take it one step further and throw you a slight curveball. You had mentioned the Lehman moment earlier, right? I don't think it's a stretch to say that even the worst Fed members understand the situation just as well as you explained it, right? I just have to imagine that in my brain. I can't not understand it that way. So with that in mind, is it possible that the Fed understands the sovereign debt crisis, not only locally, but abroad, and all the sovereigns, everyone else, and they're actually weaponizing the dollar, and they're accelerating things using the dollar as leverage to ensure that that next Lehman moment happens somewhere else rather than right here in the heart of America?
Well, I agree with you and disagree with you in different aspects of, does the Fed understand how the system works? I certainly agree. They understand. They understand how it's wired. They understand what I said about Fed credits not really being fungible. The rest of us use bank credits. We treat it all as if it was dollars. Brent talks a lot about euro dollars, as do a few others, which are created by offshore banks. I think the Fed understands the mechanics of that, really well, much better than their critics. So that part, absolutely. I think they also understand the interconnectedness of the world. The idea that, that would safely happen over there and not affect us over here. I think the Fed kind of see that everything's interconnected. Who are the creditors of that entity that failed over there? And then pretty soon you get back to big money center banks, in Germany and London and of course in New York. What I don't think the Fed understands, because there isn't a mainstream economic theory that even teaches this, is the idea that the interest rate is falling pathologically, and that a falling interest rate, first of all, is an increased subsidy for increased production, i.e., it is a downward force on consumer prices. I don't think the Fed gets that, or that a rising interest rate is a disincentive. It's an incentive that when your factory goes end of life and you're building your business case to borrow more money to build, to buy new machines and start all over again. But now with a higher interest rate, you don't have a business case anymore. And so you just have to close. And it hollowed out and gutted American industry in the 1960s and 1970s. I don't think that's well understood. And the pathological nature of the system, the fact that irredeemable currency has no extinguisher of debt, and therefore the debt necessarily rises exponentially. I don't think they get that there's no extinguisher of debt. I don't think they, in theory, I don't think they get that the debt necessarily goes exponential. I don't think they understand why the interest rate's unstable and falling and will continue to fall. Those things I don't think they get at all. But anyways, as far as, weaponization of the dollar, that's a term that I kind of object to. Not that I don't see, what they're doing with it, but rather I would use the word politicized. And I would go back straight to the root of socialism. What does socialism do? It takes from the private owner the means of production, or at least control. So in the case of National Socialism, as in Mussolini fascism, they'll let you own the factory, but they control it. They have a gun to your head, and they tell you what to produce, how to produce it, what to pay the workers, what prices to charge. And any disagreement, they blow your brains out and they just get the next guy. So that's National Socialism. International Socialism, communism, they just outright expropriate it. But in both cases, what they're doing and they claim it's more efficient and more better and this and that and the other thing, and serves the poor people or whatever propaganda they use. But what they're doing is they're politicizing economic decisions. The private economic actor, in seeking a profit, is trying to perform economic calculation, and socialism is trying to replace economic calculation with political calculation. Suddenly, it's which political interest group or which voting blocks can be aligned around do it this way versus that way. And so people say, well, it's less efficient. Yeah, in a sense, but it's politicized. And politicized necessarily means weaponized. There's no such thing as a politicized decision-making process that isn't, at the same time, also a weapon against whichever classes or interests or groups that are politically out. And that's why, as things become more socialized, the differences between the political parties become more hardened, and members, the rank and file members of each party increasingly demonize the members of the other party or other parties, in the case of Europe, and hate them and, wish them, ill, is because they're desperately competing for control of a politicized system, because whoever has his hands on the levers and buttons, has a very powerful weapon against all the other interest groups. This isn't new to today. I mean, what the French were complaining about to Secretary Connolly in the late 60s was essentially the same thing. I mean, weaponization was not a contemporary term in the late 1960s, but when he said it's your problem, it's our dollar, but it's your problem, he was essentially being smug. Yeah, that's a missile and it's aimed at you and we have the button and, too bad. So there's nothing new under the political sun in that sense.
Right. That all makes sense. And as you mentioned, things getting more socialized, it almost makes me wonder, because the Fed's the biggest elephant in the room right now. They're getting all the news and all the attention, and rightfully so. It's a big deal. All of their policies are going to affect us all globally. So I get it. But I almost can't help but wonder if it's the politicians who pose the bigger threat, once they're up to bat to start solving all of these problems, we might say, that are coming up around the corner, really baked into the cake, because I could foresee these people implementing UBI, right, to help the lower class. This could come in a lot of different ways. They might lower the requirements of food stamps. They might increase the dollar sum that you get a month. There are a lot of things that they can do to put more money out there to fight inflation, quote unquote, right? I almost wonder if the politicians are about to make more policy errors than the Fed even can dream of now. What do you think?
Let me just interject there and just say, somewhat tongue-in-cheek, but somewhat seriously, what is this distinction you make between the Fed officials and politicians? Because I would say the Fed officials are themselves politicians. They're political creatures.
I agree with you on that. I actually do.
I have a little rant that I do, and I say, there's three kinds of people running around calling themselves economists. They're and I use the French term dirigistes, which are the central planners, and they use a veneer of, economics, or economology or something like that, to coin some new term for it, to basically centrally plan and get control over your life or our lives. Then there are the court economists that use, economology to sell propaganda to the victims of the dirigistes. And there aren't that many actual scientists who study the economy to say, how does this work? Why is this, going this way? The Fed is the, pseudoscience cover for the worst sorts of political impulses, and of course UBI, universal basic income, is the embodiment of Karl Marx's famous, vacuous slogan, to each according to his need. And that's, I think politically we may be going in that direction.
So you're working on solutions to these problems, right? You have the Gold Institute for Money, right? Your Gold Standard Institute. And how do you solve these problems, right? What's the solution? Because as much as I love gold and silver, right, I don't want to be like Peter and Paul and Thomas, right, walking around with bags of silver, let alone Judas, right? So what's the middle ground between that, walking around with hard, sound money, and quick point of sale? I walk in, I get out. How do you make this work with sound money?
So I founded two things. I founded a 501c3 nonprofit called the Gold Standard Institute, whose purpose is education and outreach, on the issue of gold and a free market and money, and what we call honest money. Sound money, I think, can be a little bit more ambiguous. And I founded a for-profit company called Monetary Metals, and both of those have the same end, which is to try to help the world rediscover the virtues of the gold standard. One by education and outreach, and the other by offering interest to holders of gold. So I guess first I have to sort of start with the problem statement. The problem statement is that gold is exiled from the monetary system today. But what you do with gold, it has no effect on the monetary system whatsoever. And that's one of my, when you see all the arguments about manipulation of gold, one of my arguments why they're not manipulating it is they don't care and they have no economic reason to care. If you buy gold from the next guy, then you give your dollars to the next guy and he gives you the gold, you're out of the dollar loop, but he's in it. And so nothing happens in the banking system other than they change the name on the record of those dollars from your name to his name. Whereas before 1933, as I said, it wasn't a purchase of gold. You went and redeemed your dollars at the bank, and then the bank had to sell assets in order to give you the gold coin. That was actually defunding the credit system, forcing the sale of bonds, shrinking the bank's balance sheet, and pushing down the bond price with all that selling, which pushes up the interest rate. So before 1933, when we had a functioning gold standard, the desire to hold gold coin had a very profound and vital economic function that today has been totally exiled, totally banished. And so I think today, if you say, let's have a gold standard, let me start by kind of a common fallacy, and you can see the thinking, and we have to pick apart the knots in this thinking to get something that makes sense. So the common thinking, if you say, let's have a gold standard, what is a typical Keynesian or monetarist? I mean, the Friedmanites are not really all that different from the Keynesians. What's the typical retort? They're going to say, well, there isn't enough gold to have a gold standard, right? I mean, that's like the sort of classic thing. And then what does the gold person typically retort back to that? It's just a matter of the right price. Yes. Now, here's the problem. There is no price at which gold will spontaneously begin to circulate. That idea, I mean, in a certain sense, yes. I mean, if gold were priced too cheaply, money prices expressed in gold wouldn't be right, and whatever. But the idea that the price of gold going up is going to somehow spontaneously cause gold to circulate, it's the same fallacy, by the way, adopted in the Bitcoin community. They think there's some magic price, then all of a sudden, you get circulation. But gold isn't going to circulate that way, neither is Bitcoin, but for other reasons. Gold isn't going to circulate as a matter of rising price. And in fact, those arguments would have been made in the end of the 1990s when gold was $250, $300 an ounce. And now, here we are, we got to almost 10x that, and it still didn't begin to circulate. And there weren't even any preliminary signs that it would even begin to be circulating at $2,000 an ounce. So what magic level? There is no magic level. What you have to have for something to circulate is people have to have an income in the form of that money. So today, gold is not, nobody has gold income, except for monetary metals clients. I'll get to that in a moment. Nobody has gold income. Your income's dollars. And if you have any gold at all, it's because you bought the gold. And buying gold now, in so doing, the gold isn't acting as a currency anymore. Now it's a capital asset that you're holding because either you expect the price to go up, you think in those terms, and I argue that people should be thinking in gold terms and say the dollar is going down, not that gold is going up. Or you're holding gold because you think the dollar is all the things that I've just spent the last hour or so, saying that it is. So you hold the gold, but now the gold's a capital asset. Who wants to spend their capital? I mean, that's why the Fed has to, I mentioned earlier, people are consuming capital. The Fed has to play an elaborate game to fool people into doing that. But nobody wants to be the prodigal son, just in the plain light of day. So it becomes a capital asset, something you tuck away and it's not for spending really. So, but if people have a gold income, well, it's logical to spend your income, and so one, not I don't think this is the essential or core proposition of monetary metals, but one sort of key feature of it is people who deposit gold are earning interest on their gold in gold. They now have a gold income. And if there were a marketplace in which they could spend that gold income, some of them are in accumulation mode, but some of them would spend it. Not the principal, mind you, but the income that they earn on the principal. So getting income on your gold is a key, or getting income in gold, I guess I should say, is a key feature of the gold standard. But now let's look at the other side for a minute. And I've written a lot about this in the context of Bitcoin. Most of what I'm about to say would apply equally to gold, which is number one, merchants don't accept Bitcoin today, and they advertise that they do, but it's really a pretty elaborate sleight of hand. So let's say you're in the business of selling flat screen TVs. So you advertise, you have a website, and say, okay, this flat screen TV is $1,000. It's a low margin business. As soon as you sell that TV for $1,000, you're sending $950 probably to the distributor, and the distributor is probably even lower margin. He's probably sending $920 to Samsung or LG, whoever made the TV. So you can't take Bitcoin onto the balance sheet and take the risk. Bitcoin could move more in an hour than your margin on selling that TV. So what the merchants do is they hire a third-party currency exchange, and they do it with pretty fancy APIs to make it all seamless. But basically, the customer shows up with Bitcoin, whatever $1,000 worth of Bitcoin is at that moment, and the customer says, "I want to pay that to the merchant." The merchant is just saying to the currency exchange, "I need $1,000. Whatever you do on the Bitcoin side is up to you. I don't know about it. I don't care. I don't do economic calculation in Bitcoin, and I certainly don't take Bitcoin onto my balance sheet. Give me $1,000, and whatever price you charge on Bitcoin to get me that 1,000, that's all I care about." So the customer shows up with a Bitcoin. The third-party currency exchange finds a fourth party. That fourth party has dollars and wants Bitcoin. So then the currency exchange brokers this little complicated little multi-party swap where the fourth party gives up the dollars. The customer who wants the TV gives up the Bitcoin. The fourth party gets the Bitcoin. The customer gets the TV. The merchant gets the dollars. And the currency exchange gets a fee, either in Bitcoin or dollars, probably dollars, but doesn't really matter. And then everyone says, see, they're accepting Bitcoin. They're not. It's just that computers are fast enough and APIs are pretty slick nowadays and makes it all look pretty seamless. But it's a complicated multi-party swap. You're not really using Bitcoin as a medium of exchange. And the reason is that the TV, so the merchant is just a reseller and very low margin. The distributor is a reseller and very low margin. The TV producer borrowed dollars in order to finance that factory that produces millions, stamps out millions of flat screens. They borrow dollars. They have to finance the factory. That means borrowing, and dollars are what they borrow globally. They don't borrow Bitcoin and cannot borrow Bitcoin ever because Bitcoin's too unstable. Bitcoin is promised by its advocates, by its leading proponents, it's going to go up another 50 times or something like that. And then some of them, if you watch Michael Saylor, it's going to keep going up to millions and tens of millions and hundreds of millions of dollars, even beyond that. Nobody in their right mind can borrow something that's going to go up 50 times. Imagine in my previous example, you want to finance your factory, you borrow $10 million worth of Bitcoin, and then it goes up to 500 million, your debt goes up to $500 million. You'd be bankrupt. You couldn't afford the monthly payment on it, and there's no way you could ever amortize the debt. So they borrow dollars, which necessarily means they have to be paid dollars. It is dollars they need. And they can never accept anything that has a volatility that it's uncertain as to how many dollars they're going to get because they're a low margin business too. So the dollar system is held up. This is the dark, secret of the dollar and its underbelly, and how does it work and why does it work? Every producer of everything has borrowed dollars, and therefore they have to produce as much as they possibly can in order to dump the goods on the bid price to raise enough dollars that net of expenses, they can service their debt. That is what gives the value to the dollar, because everybody thinks of the value of a currency in terms of its purchasing power. Every producer of everything you might want to purchase is desperately, urgently, frantically trying to produce more and more and more to dump that on the bid price to raise the dollars they need to service their debt. So we don't have that in gold. I'm sorry, you want to interject?
Oh, no. Keep going.
So we don't have that in gold. We don't have that in Bitcoin. It's impossible for it to ever occur in Bitcoin. Bitcoin's far too unstable. However, gold is stable. Even today, they've banished it from the monetary system, but gold hasn't really changed its characteristics. Its properties of gold still hold. Gold is stable. It's actually the dollar that bangs around a bit. But in gold terms, the dollar is not, or even if you want to state it in dollar terms, gold is nowhere near the instability of Bitcoin. So I had a debate against a Bitcoiner a couple of weeks ago under the auspices of the Soho Forum. And I started out by saying, if this debate were about which asset, gold or Bitcoin, is better at skyrocketing and also crashing, then I would shake my opponent's hand right now, walk off the stage, and concede the debate. Bitcoin is obviously far better at skyrocketing and also crashing. Gold just doesn't do that, which is actually rather the point. Anybody that wants to find an asset to bet on in the Fed's casino to win more dollars would be best advised to find something else. Gold isn't really that asset. It doesn't do that. So, I'm sorry.
I was just going to ask if there is anything about Bitcoin or crypto that you could give credit to, that you could speak well of, that you thought was a novel and has turned out well.
It's a very clever solution, but then I have to add it's a solution looking for a problem.
Right.
I think blockchain technology is interesting. Maybe there'll be some interesting applications of it. In my side of the world, I keep hearing about how that's going to allow companies to track their supply chains, and tracking supply chain is increasingly important to everybody. Maybe blockchain becomes a public, visible ledger of, supply chain, movement of commodities. Okay, sure, maybe I can see that. So anyways, so you got this problem of finance. Nobody can borrow anything that's unstable because they can get killed. But they could borrow gold. Historically, until 1933, they did. To borrow money meant to borrow gold. And sure, we called it dollar. We called it taler, THALER. Before that, we called it all sorts of things. But these were all words for gold. The government by legislative fiat, or excuse me, by executive order fiat in the United States, just said, well, no longer. That was it. But gold absolutely can finance productive activities, productive enterprise in the real world. So another really important distinction I make is between investment and speculation. And most people have sort of a vague negative connotation to speculation, either around the concept of gambling or the concept of at least high risk. And then the people who speculate professionally say, no, it's all investing. But I would say, here's the distinction. Investment is financing production, and the investor's profit or gain ultimately comes from a piece of the increased production that was made possible by his money. Speculation finances nothing. It's simply a bet. It's simply a bet on a chip in the casino that something's going to go up, and the next speculator will buy it off of you at a higher price. And he's doing that because he's betting the next guy is going to buy it off of him at an even higher price. And then you begin to see what the problem is when you think of it, in those terms. So anyways, Bitcoin isn't financing anything. It's a bet. And maybe they're right. Maybe Bitcoin will go back up to $69,000. Maybe it'll hit $169,000. I don't know. I don't presume to know where the price is going to bang around on its random walk ultimately to zero. But in the short term, maybe it's $1 million. I don't know. But it's not financing anything. It's just a bet. Each person who's buying in is giving an exiter his exit liquidity. Someone is selling. You're just forking over your money to the previous guy in the hopes that the next guy will fork over even more of his money to you. You don't get your money back. You get the next guy's money, and so on and so forth. And eventually you run out of, fresh blood, and then, the system fails. But anyway, so getting back to finance, gold can finance productive activity. And that is what monetary metals is doing with gold. So my economic theory during the time when I was studying was, and I used to have I always had a slide in my slide deck, which is kind of a picture of a plumbing system, a part of a plumbing system. And I had what I think is called the check valve, but I'm not a plumber, so don't have any plumbers listening to this and correct me on what it's called. But it's that valve that it's a lever that can bend 90 degrees. And if it's parallel with the pipe, then it allows the flow of the water. And if you bend it 90 degrees or turn it 90 degrees, then it's perpendicular to the pipe, and then it stops the flow of the water. And so I said that is analogous to the interest rate. The interest rate in the gold standard is the regulator of flow. And if the interest rate is non-zero set by the market, then the gold will flow. You know, a gold standard or any currency standard, same issue with Bitcoin again, it's not about everybody hoarding stuff and hiding it and you know, the money becomes static. It's about movement. The gold is on the move, or the currency is flowing. There's a velocity to it. And if you have a zero velocity, that's a problem. So imagine if you had a working gold coin standard. And I'll get back to that in a minute with, you know, people are going to carry around gold coins in 2022. But imagine you had a working gold coin standard, and suddenly, for some reason, the interest rate was slammed to zero. Well, then everybody who wants to save part of their wages for retirement is going to be picking gold coins out of circulation to put them under the mattress. Eventually, you're going to run out of gold coins, and then the whole system would seize up. And so the interest rate is very much, you know, either going to allow, you know, flow or restrict it and shut it off. So anyway, so that was the economic theory. And as I was thinking about how, you know, what the business model for monetary metals was going to be, I was thinking that turns into, right, when you start in a startup, you have to think, what's my hypothesis that forms my business model? And the hypothesis was that gold will come out of private hoards for interest. That interest, in fact, is the only force that will pull gold out of private hoards and into the market, into circulation. And by the way, that extends even to if the government sends people door to door, you know, cops or military door to door with machine guns. They don't get a lot of gold. Sometimes you catch people by surprise. They have to turn over their gold. But mostly what it does, it forces people to bury it deeper. And I think that's what happened to Mao in China. He got some gold, obviously, but I think most of it was just buried deeper. People just hide it. They don't want to give it away. So anyway, so the thesis was gold will come out for interest. And then that became the sort of founding idea for monetary metals. We will offer interest on the gold, and we're going to pay that interest by finding productive businesses who need financing and qualify for that financing to be in gold. So we're not doing this for dollar-based, you know, hamburger restaurants and shoe stores and flat screen TV vendors right now. We're doing this for gold-related businesses, but we're matching. You know, a business has a need for the gold. The investors have the gold. We're matching the two, and the business is happy to pay interest for the privilege of getting the financing that they need to enable or increase their production. Now, the reason why this is okay, that's interesting because it gives savers a way to earn interest in a world where the central banks have waged a war on interest. And unlike all the other wars on nouns, they've won this war. This war is all but over. And my prediction, I'll go on the record, I'll die on this hill if necessary, is that this attempt by the Fed to hike interest rates will be abortive like all the previous ones. They will cry uncle. As I said earlier, I can't tell you exactly when or what interest rate they will do it at, but they will. The war on interest is all over but the shouting, which means that if you're trying to save part of your wages and prepare for retirement one day, you're deprived of a means of doing so. And monetary metals is offering that means, and we're paying interest in a form of money that's not subject to the Fed's debasement. Right on the Fed's website, they say our goal is price stability, they call it. George Orwell would be either crying or proud, depending on how you look at it. Price stability, which means relentless 2% debasement forever. That's what they call price stability. So if you're getting 2% interest on your dollars, that's actually zero because you're on a treadmill running backwards at 2% set by the Fed. And if you get 2% on your gold, then there is no treadmill, and there is no, central planner of gold that's capable of debasing it like that anyway. So we're doing something. We're serving an unmet need of the saver, but economically this becomes even more important because, as I was saying earlier, what is the thing that keeps everybody locked in stasis in the dollar system, which they hate? It's the need to service the debt. Why do we have to service the dollar debt? Because that's where you get the credit. It's like the old joke when somebody said to, is it Billy the Kid, why do you rob banks? And he said, because that's where the money's at. Why are they in dollar debt? Because dollars is where you get the financing you need to, build your business. Now, gold, we will get to the point where gold is capable of replacing that dollar and financing productive business. And businesses will be happy to stick to it because gold is more stable than the dollar. The dollar is intended to go down at a steady, smooth 2% per year. Unfortunately, the dollar has wicked counter-trend moves, which is happening right now, and that's why all the stress is on all the debtors. And so those counter-trend moves can wipe you out. Whereas if you borrowed in something stable, you wouldn't be subject to that. So our intention is to make it possible for savers to save and earn interest, as historically was long the case. I shouldn't say always, was long the case, and make it possible for producers to borrow something that's more stable and replace their dollar indebtedness with gold financing. And of course, the gold financing can be repaid in full, unlike the dollar, which is there's no extinguisher of debt. It's just it's an endless loop and exponentially growing. So that's what monetary metals is trying to do. If we succeed at doing that, right? So I think a good working definition, or a definition of a working gold standard, is when anybody who wants to can deposit their gold and earn interest on their gold. Notice I defined it in terms of the right of the saver to get interest, not the right of the consumer to spend gold. You can do that today. If you find a willing seller who will take your gold, you can do that today. That's perfectly legal. But I defined it in terms of the right to be able to deposit and earn interest on it, which is the key to the whole thing, because that's finance. When anybody can deposit their gold and earn interest on their gold, that's a working gold standard. And every other feature that you want will come as a consequence of that, not the cause but the effect. The circulation of gold as a medium of exchange will come as the consequence of the fact that gold is being used in finance, not the other way around.
Well, Keith, you have been an awesome guest. Love your answers. You're exactly what we were looking for. Put it that way. And I have been hogging the mic quite a bit. If you want to stay a little longer, we'd love to keep you around. I know we had a couple of guests that wanted to ask a question. If you're okay with that, sticking around another minute.
I've got 17 minutes.
Okay. Jim, you want to go ahead and knock out your question, bud?
Sure. Hi, Keith. Jim Hunter.
Hey, Jim.
Keith, I just wanted to add to what you're saying is that there's some awfully smart people worldwide, even smarter than some domestic people in the United States, in the form of they're given the task of investing central banks' money, or currency, I should say. And just to add to support your thesis, a lot of those central banks worldwide are trading their currencies for gold. Their gold stash is going up in terms of their reserves. Their decision to hold reserves is increasing in gold. And they are, in effect, they can be printing their currency and swapping that from a gold seller to increase their gold. Could you please just give me what you might think an answer would be to why the United States, the Federal Reserve has not printed money to increase their gold? Our gold, I believe, is around 8,300 tons, and it's been steady for decades. Do you have an opinion why the United States is not increasing their gold reserves? Thanks.
Yeah, so I've had many conversations with, central bank officials, both in the U.S. and globally, not at the level of Powell or Bernanke, but, one level down and two levels down. I've had a lot of conversations, both in the U.S. certainly, but in the rest of the world as well. I have not encountered people, in central banks or generally, politicians and, most other walks of life who really think about gold, who really get it. I think if you were to talk to, um, anybody at the Fed or anybody at most of the other major central banks and say, why aren't you thinking about gold, or why aren't you doing something with gold? I think you might get kind of a puzzled response. Like if you went to an engineer at Tesla and said, why aren't you building a better carburetor? I think they'd kind of look at you like, dude, wasn't that obsolete? Like, in 1913 or 1971? And they wouldn't even necessarily, they wouldn't have the dates clear in their mind. It would all be very vague and very fuzzy, very, very vague and very fuzzy as to what happened exactly when. But they would just say, look, that's been gone for 100 years. I don't think they would think about it. There are a few central banks that are buying gold. Absolutely, I imagine they think that the price of that gold is going to, that's why they're doing it. And of course, there is a danger, right? So central banks, we call it printing, but it's borrowing. You borrow in order to buy an asset. That's leverage. And if the asset goes up, you win. And it's a lot of fun. And if the asset goes down, you lose. It can be a lot of pain. The Swiss National Bank just announced dreadful losses, not on gold, but on other portfolio assets. So it can be a dangerous game depending on how much leverage they're using.
I might add that I have heard James Rickards say that each of us, every listener that's listening tonight, each of us can have our own gold standard just by trading, hard-earned U.S. dollar currency for gold from any retail seller. I mean, so each person here, if they've got more faith in a solid 5,000 year asset than they've got in the U.S. dollar, you can trade your confidence-backed currency for gold. One more thing I just wanted to add in Keith's defense of trying to earn a return on your gold. I'm a futures broker. I have been for a long, long time. And there's an investment called a covered call where you own the underlying and then you sell a call against it. Well, you can't do it with your gold coins. You can't do it with a gold bar. You can't do it with a silver bar, but you can do it with a gold futures contract or a silver futures contract. And you're not going to get silver back, but you're not going to get gold back. But you can buy, let's say you buy gold at $2,000 an ounce and you write a $2,100 call against it. You can pick how much time you want to sell. You're going to get, it's a guaranteed trade. You're going to get the call when it's a covered call. You're going to get the call premium guaranteed. The risk is in the futures contract and at that point. And you can, if you do that over a given amount of time, 3 years, 5 years, 10 years, your stash should increase. Your stash of currency should increase that you can take that currency and buy more gold with it. So it's an artificial way of earning a yield by using a covered call. You can do it on stocks too, but I need to caution you that I watch stocks a little bit. Stock options don't pay anything like futures options when you're selling them. Thanks a lot.
So the challenge with that is just when you really want that gold, because the dollar is really beginning to drop sharply, that will be manifest in a vastly higher price of gold. Your gold will be called away from you.
Oh,
it's okay.
It's okay if it gets called away. It's different than a coin store because you can, if your gold gets called away at option expiration, you can turn around that following Monday. If they expire on Friday, you can turn around that following Monday and you can buy the gold again at $2,100 and sell a $2,200 call. So that's
but you lose. So let's say you have 100 ounce, which is a regular gold futures, 100 ounces.
Yes, sir.
And you have the capital to own 100 ounces at $2,000. When the dollar begins to drop drastically and the price hits $3,500, but you sold a call at 2,100, yeah, you can buy the gold again at $3,500, but you have, almost half of the gold that you used to have.
Well, first of all,
if you're trying to trade for paper gains, that's a great strategy. If you're trying to hold some gold as a way to weather the storm that's coming, people should keep in mind that isn't gold. That's a paper strategy.
No, I understand. I fully agree with that. What my point is is that if the $2,100 if that futures goes through $2,100, you can buy the futures again that following Monday and start all over. You can buy a $2,100 gold futures contract and sell the $2,200 call. Also, just to remind you and everybody listening, gold has not been $2,100 yet. It's about 2,079 is about the high. So a $2,100 call, you'd be betting on all-time highs, and you're rewarded from it, depending on how much time you sell. If you sell a 3-month call or something like that, you can, the more time you sell, the more premium you collect, but there's more time for it to go higher to take your gold away. But
there's a risk to that strategy, which is you've now doubled your balance sheet. You now have 2 gold futures. You're short 2 calls. One of them is now way in the money. So you bought a second.
Keith.
So you bought a second call, and then the second call is your open position. Now you've doubled your risk.
Keith, I did not say that. I said if you bought the gold at $2,000 and you sold the $2,100 call, and let's say it gets exercised at the expiration. Let's say you sell a December.
No. Wait. Stop right there. Back up. Let's say the price of gold shoots up to 2,800 because the dollar's collapsing. It shoots up to 2,800 before expiry. In other words, you still have a valid gold call out there, 2,100. You have a $2,800 gold price. Your gold will be called away from you next month when you get to expiry. But in the meantime, you don't have a gold position anymore. You could buy a second gold future, but now you're adding to your leverage.
I know, but Keith, that gold, that $100 difference on a futures contract is $10,000. Plus the $100, whatever you sold the call for, plus the $10,000 will finance another gold futures contract. The gold margin, let's say it's between $8,000 and $10,000. You made that much on the gold going from $2,000 to $2,100 in the leverage market. It's $10,000 per $100 per contract of gold.
Oh yeah, they will give you more leverage. I agree with that. But you now have more leverage, and with that more leverage means more risk.
Well, you just told us all that it's going to $2,800. I realize that
which could be a spike, which could be a temporary spike. People get flipped out of positions with leverage on spike lows and spike highs.
Yes, sir. My point is that using that strategy, a covered call strategy, the money that you sell the call for, the premium as it's called, at that strike price you choose, it's a guaranteed gain to the futures trader, to the futures trader's long that has the covered call strategy on in their trading account. It may go to 2,100, it may go to 2,200. My point is that it's a way to increase your futures account in dollars on a consistent basis over the course of 3 months, 6 months, 2 years, 4 years, 6 years. And you can use that extra call money to buy more gold, in effect, supporting your opinion of getting a return on your gold.
Yeah. We can listen to the replay later and understand each other after the fact. We only have a few minutes here, so we don't want to argue over that. But thanks, Jim, for the question. Alex, do you have anything that you want to add, buddy?
Again, it's been really great having you on. I guess the question is, what kind of return would you, what are the ranges of returns you could get using your services?
So we have 2 different programs. We have a gold leasing program where the gold is physically present and under monitoring and insurance and a whole bunch of other things. And this is for businesses like jewelers, mints, refiners that need gold physically in their production process. And in those lease deals, the interest rate is 2 to 3% in gold net to the investor. So if you gave us 100 ounces of gold, then you'd have 102 or 103 ounces at the end. We also have a gold lending program. Lending is, first of all, for accredited investors only. The risks obviously very different for lending, let's say, to a gold mining company. So in a recent gold lending deal that we did, the interest rate was 13%.
All right, rock and roll. Well, Keith, you've been an excellent guest, as we had mentioned. We really appreciate your time. If you don't mind, I'd like to send you out on a fun little lightning round here. All right, so I'll give you a couple of multiple choice answers with a category to follow, like what's more likely, A or B, and we'll just zap through this thing. It's going to be kind of fun. All right, what is more likely? A tether crisis type event kills Bitcoin, or the government kills Bitcoin?
Tether.
What's more likely? Hyperinflationary collapse or stagflationary lost decade?
Lost decade.
Which comes first? QE5 or the Fed hits 4%?
I don't know. That's a toss up. They seem hell bent on 4% or more, but
All right.
on the other hand, the stresses are building.
Okay. Next, which comes first? Silver to 50 or gold to 3,000?
That's interesting. I'll take gold to 3,000.
Okay. Judges agree with you. This is the correct answer. Okay. Which do you prefer? Gold or silver?
It depends on which part of the portfolio.
Let's say I'm gonna stamp this down for you. You got to buy one today and keep it forever.
Gold.
Gold. Okay. Milton. Who do you like better, Milton Friedman or Ludwig von Mises?
Mises.
Ayn Rand or Rand Paul?
Ayn Rand.
Ron Paul or Thomas Jefferson?
Thomas Jefferson.
All right. Okay. How about Thomas Jefferson or John Locke?
John Locke.
Oh, I like it. A man after my own heart. Skinny Elvis or fat Elvis?
I wasn't really much of an Elvis fan, but I think Skinny Elvis is better.
Okay. Okay. You know, Elvis is still alive. All you got to do is come over to my dad's house. He thinks he's Elvis. Okay. All right. Just a couple more. Back to the Future, Indiana Jones.
Indiana Jones.
All right. We're getting to the meat here. The Beatles or the Electric Light Orchestra?
Beatles.
Okay. Maybe most important of all, Keith, this is a big one. This is a big one. What is the best temperature to cook a steak?
Rare or medium rare?
No, this man's got a heart of gold. You win. You're welcome back anytime. A degree over medium. I don't know. We might not let you back on, but you're a great guest. We really appreciate you coming in, man. That was good stuff.
All right. Thanks for having me.
All right, buddy. Take care.
Take care. Bye-bye.